Welcome to the daily stock review of Lululemon. Goal is channel to uncover the world's best stocks that have 100x potential by reviewing 1,000 stocks in 12 months. That's 3 a day. If that sounds good, subscribe to come along. Who am I? I'm an individual investor on the journey. I'm just 2,500 hours in over the last 7 years, and I'm sharing the lessons along the way. Here's my investing process. Today I'll go over how I came across Lululemon stock and the 5-minute check to see if it's worth looking into further. These are the investors that I learn off. They've done pretty well for themselves, and by following the breadcrumbs that they've left behind, we'll be able to follow that success trail. If you'd like the resources I wish I had when I first started out, calculators, investing checklists, etc., grab that for free. It's in the link in the description. All right, let's crack in. So Lululemon stock, it's gone down 70% over the last 5 years, and sitting today at about $114. It's got a PE ratio of 9.6. So that's fairly low. That would indicate that this business is, or at least shareholders are pricing this business thinking that it's going to decrease in size in terms of whether that be cash that it's generating into the future. Okay, so for my process, I'll just grab out the annual report, grab the most recent one, which is 2025. Now, how did I come across Lululemon? Well, I'm not into it, but there's always a lot of talk. So it's been one that I've heard a lot about in terms of the branding behind it, in terms of either online through social media, other people and friends and things like that talking about it. I went and got some Lululemon, and most recently I thought, yep, I'll go and have a look up for a few other brands and things like that. And so while I was looking around at some 52-week lows, this business popped up on that screen, and because of the brand, it popped out at me, and I went, that's a very recognizable brand. A brand is usually a very strong moat around the business, so it can keep its customer base and grow it into the future. So I want to see how that's looking in the report, and that's pretty much how I came across it. While I was looking around also at that 52-week low, also found that a very notable investor has invested into the company as well. So we'll go through that. You can have a look at that. Just type in Lululemon and it'll come up with who the guy is. He did pretty well for himself in the 2007-2008 global financial crisis. It's what The Big Short is pretty much based on, his finding of that situation. So what I want to do is I want to have a look at the income statement and try and understand what's going on. If this business is being priced that it's going to decrease in value over time, I want to see what's going on. So what have we got? I've got net revenues from 2024, 25, 26, and it appears to be growing steadily. Now, cost of goods sold has increased a bit. Let's just have a look at what our gross margin is. So on that, the gross margin has, like, the money that they get after paying for the initial price of those goods has increased. Let's just go straight to the bottom line of the business and see what it looks like. So we've got 1.5, this is in thousands, so that would be 100,000, million, a billion. So we've got 1.5 billion, 1.8, and 1.58. So it has decreased a bit in the most recent year. Now, what's come out from that? So we're talking, there's been increase of cost of goods sold. General and admin has increased as well. So from 3.3 to 3.7 to 4. And it is outpacing the revenue of the business. So the money that they're getting in from sales has not increased as much as the cost of those products, as well as general or selling, general and admin. So you can think this also includes the selling component. So that could be marketing and putting money towards the brand as well, in terms of reaching a wider audience base. So digging into this number in particular would be very interesting if looking at the business further. So the general trend though is that yes, it will, at this stage, those costs are going to creep up on the business and they'll be making less net income at the end of the day. How much? It really requires a strong understanding of what are the costs of the goods sold and what this is included in that selling, general and admin. Now let's have a look at the balance sheet, because if this business is going through some temporary challenges, we want to see, is this going to be a permanent fixture? So cash equivalents on hand, 1.9 down to 1.8 billion. Inventories is a considerable amount of the money. And let's just have a look big picture. Total assets of 8.5 billion versus, we got other current, non-current, other current. Why you got to do that? Okay, so they've totaled it up. So 8.5 pretty much assets minus 3.5 billion liabilities. So business is in front there. They got property and equipment that has increased as well for the business. So that's usually a good sign. They've got goodwill is fairly low. Intangible assets decreased a little bit, but even though it's very small to begin with, and right of use lease assets, etc. Now, what about the non-current lease liabilities? So what are they got to pay for rent for their shop fronts and things like that into the future? We'd expect that to be pretty significant, this being a brick and mortar chain. And other, like, it also includes things like factories, warehouses, and things like that as well. So how do they distribute all this merchandise and product? Unredeemed gift card liability, and that's about it. Nothing too interesting there, or that screams out that this business is at risk of not paying its debts and going under. If it does get to a stage where the business is in dire straits, they can just start closing some stores, which does reduce their sales if they are getting significant amount from those stores. But usually you'll close the underperforming ones, that'll increase profit margins, and you'll decrease your lease liability as well. All right, let's go and have a look at the cash flow statement. So we've seen has the business mastered its customer? Well, I'd say it's got some pretty good market fit or product market fit. The revenue of the business is increasing. However, those costs and the management internally within the business at this stage would need to be tested further. So we don't know if they're being rational with how they're spending the company's money or not, and that would require a bit more of a deep dive. So on our cash flow statement, really we want to check out, is this business being managed well? So our net income from the income statement comes over. We've got our adjustments that happen to it. We've got changes in operating assets and liabilities. So what I'm doing here is I'm just having a look to see if there's any changes from year to year, any trends. So, deferred income taxes bounces negative and then positive. Inventories is changed. Prepaid and receivable income taxes is increased quite a lot for the most recent year. What else? We've got some other costs. We've got a reduction here in terms of accrued liabilities and other current and non-current liabilities. So this one's a little bit of a mixed bag. So we can see a lot of different things that we need to have a closer look at to be able to understand if this value is going down in terms of the net cash provided by operating activities. What does that mean for the business long term? So is it going to be able to grow that? Is it just because of a few of these items this year taking a big hit and which has decreased it further? And doing that analysis. So let's see where the business is investing its money. So purchase of property and equipment has stayed fairly steady. Net cash used in investing activities, settlement of net investment hedges, that's fine. Repurchase of common stock. Wow. All right. So it has a lot of money is going into repurchase of common stock. Now, that is a large amount. So it's got pretty much getting $1.6 billion. It spent half of that on the property, plant, and equipment just to keep it going, maintain, judging by the fact that it hasn't increased too much. It's either continuing with its investments to a consistent kind of growth amount in that, as well as our maintenance of the equipment and plant and equipment. And and then we've also got this one. So the majority of the cash is getting plowed into repurchase of common stock. And so I like to see that. And especially while the business is priced very low, the amount of stock that they can recoup for the business is a lot. And it really depends on, like I'd said, those other line items to see if they are, if the business isn't growing. Sorry, let me start again. If this business, its main brand or moat around the business is its brand, and the only way to invest in that brand is to effectively do advertising, and whether there's different types of advertising campaigns, but that cost needs to come out of selling, general, and admin. It doesn't actually say here that is being invested back in the business. Now you can think of things like Nike, Coca-Cola, and things like that. They do their advertising and branding, but it doesn't come into investing activities. And it takes, sometimes between 6 months, 12 months, 5 years for really good branding to still take off and grow the base of the business. So we'd want to have a look at how effective and how much of that advertising split is going into it. So, for instance, just trying to search for advertising. Let's go search for oh, you're playing hard to get, are you? Let's have a look then, because we want selected consolidated management's discussion. So usually in here we will see management discussion, and it puts a bit of a breakdown on the money that's getting split within the business. So we've got results, we've got revenue, here we go. Boom. This is how we do fundamental analysis at the end of the day. So, and to try and do it fairly quick without reading an entire annual report, only to come up with a handful of insights, and those handful of insights may be worthless at the end of the day. So by looking at the financial statements for that quick first 5-minute check, we can have a pretty good indication if there's something interesting to look at. So we've got increase in selling, general, and admin expenses was primarily due to an increase in costs to our operating channels, so 200 million, comprised of an increase in employee costs primarily due to increased salaries and wages expense for retail employees, primarily due to increased labour hours, partially offset by decreased incentive compensation and benefit costs. So that's not value add to the business. That's just extra cost. So that's not a good sign. Next, an increase in digital marketing expenses, 50 million. So that would be a good sign. But it's really nice to see the general trend of that over time. So whether it be the last couple of years, they've increased that year on year. What else? An increase in variable costs of 38 million, primarily due to higher credit card fees, distribution costs, and packaging costs as a result of higher revenue. Well, that's just a cost. We're not happy about that. An increase in occupancy and depreciation costs, an increase in technology costs, and increase in other costs. What else? An increase in head office costs of 67 million, comprised of an increase in technology costs, an increase in depreciation, increase in contractor advisory and professional fees, an increase in brand and community expenses, 7.8, an increase in other head office costs, an increase in employee costs of 5.7 million, primarily due to decreased incentive compensation, including a reversal of stock-based compensation expense during the second quarter due to a change in the probability of achieving performance conditions, partially offset by increased salaries. What else? A net increase in net foreign currency exchange and derivative. All right. So what does that tell me? So a very well-run business is able to control costs very well. So we're talking, 250 million, 300 million pretty much. Yeah, there we are. Across the 2 years, and they're telling me that there's only a couple of line items here that are actually value add to the long-term part of the business. They've got costs, all going along. Maybe this one for brand and community expenses. So that would take this to about 60, just under 60 million. But there's $240 million worth of just extra cost that's not adding value to the business. It's taking cash away from the business. And so at this stage, that's not a good sign. Now, another one would be cost of goods sold. Having a look at how that's split up. They do have around the world their growth and things like that. But we'll have a look at that into when we perform a proper deep dive on this business. That was just a bit of a taste of what I kind of do when I'm looking around into certain stocks by going in and testing those assumptions and trying to understand the numbers of the business. All right, if you've enjoyed this and you'd like to see other reviews as they come along, you can subscribe. And otherwise, check out this next video because YouTube reckons you'll like it. Cheers.